welcome to the deep dive. You're probably trying to figure out how to get steady income, right?
Right.
Especially now with low interest rates, but like high volatility everywhere.
Yeah, it's definitely a challenge. So today we're looking at something called covered call ETFs. They're pitched as a way to maybe get monthly cash flow.
Right. So forget just buying and holding for a sec. These ETFs own stocks, but they do something extra.
Exactly. They sell call options on those stocks they own. That's how they aim to generate income for you, the investor.
Okay, so our mission today is basically to break down how that works, what the good and bad points are.
And figure out if this strategy might actually be right for you if you're looking for that income stream.
Perfect. So,
Yeah.
covered call ETF. Let's unpack that term first. What does covered mean here?
Covered is pretty straightforward. It just means the ETF actually owns the underlying stock. They have it in their portfolio.
Okay, so they're not selling something they don't have.
Nope. And call, that's the type of option. They're selling the right for someone else to potentially buy that stock from them later.
At a specific price, the strike price.
Precisely. The buyer gets the right, but not the obligation to make that purchase.
Got it. So how does selling these calls actually make money for the ETF and then hopefully for me? Can we walk through a quick example?
Yeah, let's use Apple. Say the ETF owns Apple shares and they're trading at $100.
Okay, $100.
The ETF might sell a call option that gives someone the right to buy those Apple shares at, say, $110.
Okay, higher than the current price.
Right. And for selling that option, the ETF collects money up front. That's called the premium. Let's say it's $3 per share.
Okay, so that $3 is instant income, sort of.
Exactly. Now, two main things can happen. Scenario one, Apple's price stays below $110 until the option expires.
Then the option is worthless.
Correct. Nobody wants to buy at $110 if they can buy cheaper on the market. So the option expires, the ETF keeps their Apple stock.
And they keep that $3 premium they collected. Free money, kind of.
Well, income earned for taking on the obligation. Now, scenario two. Apple's price jumps above $110.
Uh-oh, what then?
Then the person who bought the call option will almost certainly exercise it. They'll use their right to buy the stock at $110.
Even if it's trading at like 115 or 120.
Yep. So the ETF is forced to sell their Apple shares at $110. They still keep the $3 premium they got initially.
But they miss out on all the gains above $110.
That's the key trade-off. You get the premium income, but you cap your potential upside if the stock really takes off.
Okay, so income now versus potentially bigger gains later. Why would you lean towards this ETF strategy then?
Well, the main draw is that consistent income potential, usually paid out monthly as dividends from those premiums collected, plus maybe some stock dividends too.
Right, that monthly check idea is appealing. Anything else?
It can also potentially lower the overall volatility of holding the stocks. That premium income acts like a small cushion if the stock price dips a bit.
A cushion, yeah. Not a safety net, though.
Definitely not. If the stock tanks, you still lose money, just slightly less than if you only held the stock, thanks to the premium. These tend to work best, or at least feel best, in markets that are kind of flat or only creeping up slowly.
Makes sense. So the big trade-offs are clear. Capped gains are the major one.
Absolutely. In a strong bull market where stocks are soaring, these ETFs will likely lag behind just owning the stocks directly. You're swapping that potential for high growth.
For more regular income and that limited downside buffer.
Exactly. It's not a free lunch. It's an exchange. And it's worth noting, some ETFs sell options closer to the current price at the money, which brings in more premium but caps gains more severely. Others sell further out of the money options.
Less income, but more room for the stock to grow before hitting that cap.
You got it. Different flavors for different preferences.
Are there popular examples of these ETFs?
Sure. QYLD is a big one. Focuses on the NASDAQ 100, known for high yield because it sells calls right near the current price.
High income, very capped upside then.
Pretty much. Then there's JEPI, which is more active. It picks stocks and sells options. A bit of a hybrid approach.
Interesting. Any others?
Well, there's even a Korean one mentioned, Codex ETF, using a similar strategy on U.S. dividend stocks. So there are variations globally, too. It raises a question for you, the listener. Do you want broad market exposure like QYLD or something more actively managed like JEPI.
Good point.
Yeah.
Okay, let's quickly recap the main terms. Covered call means
You own the stock, you sell the call option.
option premium,
That's the income you get for selling the option.
often leading to monthly income payments.
Hopefully, yeah, that's the goal for many of them.
And the big risk?
Capped gains if the stock soars, and only a limited buffer if the stock falls hard. It doesn't prevent losses.
So fundamentally, these covered call ETFs offer you a pathway to generate income.
By trading away some of that potential for really big growth spurts, which can be attractive, especially if you think the market might just move sideways for a while.
It really hammers home that need to understand the trade-offs. Predictable income versus potential home runs, and that limited downside protection.
Absolutely. It's not about good or bad, it's about fit.
So, as you think about your own investments, weigh how much you value that regular income stream versus chasing maximum growth and how comfortable you are with those cap gains. It's about aligning the tool with your goals and market view.
Right. And maybe a final thought to chew on. How does the predictability of income from something like this stack up against the maybe higher, but definitely less certain potential for capital growth from other strategies in your specific plan?
Something to consider. Thanks for tuning into this deep dive.